Welcome to our channel, where we discuss finance and financial strategies designed to help you build strong financial foundations, stabilize your current finances, and support long-term financial growth toward financial freedom. If you need professional support with CFO services, account management, bookkeeping, financial operations, financial modeling, planning, and more, feel free to reach out to us.
Absolutely. We are always here to help you out.
Today, we're doing a deep dive into the foundational stock investing concepts from Pat Dorothy's book, The Little Book That Builds Wealth, specifically exploring how to identify long-term winning businesses.
And if you've been following along, this is the next part of our ongoing discussion series on wealth building, so definitely check out the previous video for a better understanding of the basics before jumping into this one.
Right. Highly recommend doing that. So I want you to take a second and just, think about a corporate graveyard.
A corporate graveyard.
Yeah. Just picture the sheer scale of the monuments in it. We're talking about massive, seemingly invincible titans of industry that have just completely collapsed over the last couple of decades. Enron, Lehman Brothers, Blockbuster?
Chrysler. Yeah, it's actually a pretty sobering mental exercise.
It really is.
Because we all have this natural psychological bias to view massive corporate scale as like permanence. We look at a multinational giant at its absolute peak and just assume its sheer size is an impenetrable shield against failure.
But size is really just a snapshot of who happens to be winning today.
Yeah.
And that brings us to the core mission of this deep dive we've prepared for you.
Exactly. We're not just rehashing investing 101.
No, we want to dissect the actual physical architecture of corporate survival. We're going to explore how to separate the companies that will compound your wealth for generations from the ones that are secretly setting a trap for your portfolio.
Right, because the harsh reality of the market is that looking incredibly profitable on paper today can actually be the most dangerous indicator for a business tomorrow.
Wait, really? Being profitable is dangerous?
Well, the source material uses this classic simplified analogy to illustrate the point. It compares Jack's Candy Shop, which is pulling in a massive 50% return on equity, to Jill's Just Rodents pet store, which is making a measly 2%.
Okay, let's unpack this, because obviously any rational person wants a piece of the business generating a 50% yield, right?
Of course. Oh, and just to clarify for beginners, return on equity, or ROE, basically just measures how effectively a company is using investors' money to generate profit. So 50% is huge.
Right, it's printing money. But anyone who has spent time in the markets knows that a 50% ROE isn't a steady state. It's a dinner bell.
A dinner bell. I like that.
Yeah. It's the exact moment where novice investors usually get completely wiped out because they project that high return out to infinity. But capitalism essentially has this highly aggressive immune system. High margins are the target, and competitors are the white blood cells.
That is a great way to put it.
Right. Like if Jack's local candy shop is printing money, the regional grocery chain doesn't just admire their success. They open a massive candy aisle right across the street, undercut the prices, and compress Jack's margins back down to the baseline.
Exactly. In economics, that's just called aggressive mean reversion. Capitalism's default function is to destroy excess profits. If a company is earning returns way above average, competition will invariably rush in, increase the supply, lower prices, and just compete those returns away.
Unless, of course, there's something stopping them.
Right, unless there is a structural, physical impediment preventing those competitors from entering the space. Warren Buffett famously popularized this as the economic moat.
And while the whole, medieval castle protecting its gold metaphor is an absolute cliche in finance at this point, we really need to move past the imagery and look at the actual physics of it.
Yeah, a moat isn't just having a great product. It's not having a visionary CEO.
No, it's a structural mathematical barrier to entry. But I actually want to push back on something you said a moment ago.
Oh, go for it.
Isn't massive scale eventually its own structural barrier? I mean, if a company controls 80% of a global market, the sheer billions in capital required just to challenge them seems like a pretty effective moat.
It's highly tempting to conflate size with a moat, I'll give you that. But market history is just littered with the corpses of companies that relied solely on scale.
Like who?
Look at Kodak in the film industry, or General Motors in the mid-century auto market, or even Netscape with early web browsers. They all commanded absolutely staggering market shares.
Oh, wow. Yeah, Netscape was huge.
Right, but massive market share can vanish almost overnight in highly competitive spaces if there's no underlying mechanism locking the customer in. Size is just the result of a past victory. A moat is the architectural reason they will win the next battle.
Okay, so if we strip away size, what are the actual mechanisms? The source material categorizes 4 true types of economic moats.
4 specific pillars, yeah.
And as we break down the mechanics of these, I want you, the listener, to mentally audit your own portfolio, or even just look at the apps on your phone. See if you can identify which of these 4 specific gravitational pulls they're using to keep competitors away.
So the first structural defense is intangible assets. We are generally talking about patents, regulatory licenses, or deeply entrenched brand identity.
But let's go beyond just slapping a recognizable logo on something, right?
Exactly. A true brand moat reduces search friction for the consumer and provides absolute pricing power. Coca-Cola is the textbook example here.
Right, because anyone with a chemistry set can synthesize a brown, sugary, carbonated syrup.
But you cannot legally put the Coca-Cola trademark on it. That intangible asset allows Coke to charge a premium over generic cola, and the consumer happily pays it because the brand guarantees a specific, consistent experience.
That makes total sense for consumer goods.
Yeah.
But the second moat, high switching costs, feels a lot more, insidious.
Insidious is a good word for it.
Yeah, because this isn't about making a product so good that people want to stay. It's about making the process of leaving so financially or cognitively painful that they just give up and stay put.
Precisely. It's all about friction. Bank of America is a classic retail example. Could you get a marginally better interest rate at a local credit union? Probably.
But the cognitive load of moving your direct deposits, updating dozens of auto pay subscriptions, learning a new app interface, it's a massive headache.
Exactly. But where switching costs really act as an impenetrable fortress is in enterprise software. Think about companies like Oracle or SAP.
Oh yeah, enterprise software is a trap.
Right. If a Fortune 500 company has its entire global supply chain, payroll, and HR running on a specific database architecture, ripping that out and training 50,000 employees on a new system could cost hundreds of millions of dollars.
And paralyze the company for a year.
Exactly. The switching costs are so catastrophic that the vendor can basically raise prices at will.
Now, compare that friction to the third moat, the network effect. This operates more like a gravitational pull, where mass simply attracts more mass.
Yeah, with a true network effect, the service intrinsically gains value with every single new user that joins.
It solves the cold start problem for the incumbent and creates it for the challenger. Like Google search, right?
Google search is the ultimate feedback loop. Every single time a user queries Google, they are providing free training data to the algorithm.
Which makes the algorithm smarter.
Right. The search results get more accurate, which inevitably attracts more users who then provide more data. If you or I tried to launch a rival search engine tomorrow with a perfectly engineered algorithm, we would still fail.
Because we don't have the billions of daily queries needed to refine it.
Exactly. It's the ultimate winner-take-all dynamic.
Which brings us to the fourth and final defense, the low-cost advantage. Now, this isn't just about throwing your weight around to buy in bulk.
No, it's about structural unit economics. It's about having a unique process, a geographic location, or an operational scale that allows a company to underprice absolutely everyone else in the market and still generate a healthy profit margin.
Right. So like Walmart, they don't just buy cheaper goods. They have a logistical supply chain density that is nearly impossible to replicate.
Exactly. They optimize route density for their trucking fleets in a way that minimizes fuel cost per item to fractions of a cent.
Or look at the energy sector. ExxonMobil owns the rights to historically cheap, easily accessible oil fields.
Right. If a new competitor enters the market and has to drill deep offshore wells to get their oil, their baseline cost of production is fundamentally higher. In a price war, Exxon can lower the price of a barrel to a point where the competitor goes bankrupt, while Exxon is still making a margin.
Okay, so theory and taxonomy are great, but let's actually stress test these mechanisms using some hard data.
Let's do it.
The source material utilizes a slightly absurd but highly effective thought experiment. The year is 2005. To give you some context, YouTube has literally just launched. The Motorola Razr is the hottest phone on the market, and aliens have just invaded Earth.
Naturally, aliens.
It's classic scenario.
Yeah.
But these aliens offer humanity a wager. They will spare the human race only if we can successfully allocate capital.
High-stakes financial modeling. I love it.
We have to correctly identify which companies will maintain or grow their return on equity over the subsequent decade, from 2005 to 2014. If we pick the companies heavily fortified by real moats, we survive. If we get lured in by high returns that eventually get eaten by competitors,
You get vaporized.
exactly, we're toast. So let's run through these matchups and see how this decade perfectly isolates the different ways profits get destroyed versus how they get protected.
Let's start with the illusion of the consumer trend. In 2005, the aliens asked us to choose between Abercrombie and Fitch and Coca-Cola.
This is a phenomenal trap. If you just look at the raw numbers in 2005, Abercrombie was posting an absolutely unbelievable 55% return on equity. They were printing cash.
While Coca-Cola was sitting at a respectable but significantly lower 17.9%.
The temptation to chase that 55% yield is overwhelming. But if you took the bait, humanity gets zapped.
And we get zapped because Abercrombie's ROE completely cratered to 16.4%, and their stock lost 56% of its value over the next 10 years.
Ouch.
Yeah. Meanwhile, Coke grew its ROE to almost 30%, and its stock more than doubled.
And the mechanism of destruction here is that retail fashion possesses zero structural moat. It is a highly fragmented, hyper-competitive industry entirely dependent on the incredibly fickle tastes of teenagers.
Exactly. Being culturally cool is a temporary state, not a sustainable competitive advantage.
So Abercrombie had high returns, but absolutely no wall to protect them. Coke, on the other hand, leveraged an impenetrable network effect in its physical global distribution.
Right. They control over half of global soft drink sales. A competitor might make a better tasting soda, but they simply cannot secure the shelf space, the restaurant contracts, and the global supply chain routing that Coke spent a century building.
Makes total sense. Now let's pivot from the fickle nature of fashion to the fickle nature of technology and entertainment. The aliens give us a choice between Walt Disney and Nintendo.
This one is fascinating. From 1995 to 2004, Nintendo actually outperformed Disney, holding a 15.1% ROE compared to Disney's 12.6%.
And this is right as Nintendo is gearing up to launch the Wii, which goes on to be one of the highest-selling consoles in human history. You would think that secures the decade for them.
You would think so.
Yet over the next 10 years, Disney's the clear survivor. Disney's stock rockets up 298%, while Nintendo's stock actually drops 11.5% in value. I look at this and I have to ask, doesn't Nintendo have an incredible intangible asset with characters like Mario and Zelda?
It's a great question because they absolutely possess top-tier intellectual property. But the structural reality of the video game console market is that it is a brutal, hit-driven hardware cycle.
Meaning you practically start from scratch every few years.
Exactly. You're practically starting from zero every time a new console generation launches. If the hardware misses the mark like the Wii U did disastrously in 2012, your profits completely evaporate regardless of how beloved Mario is.
Nintendo actually posted operating losses in the early 2010s.
Right. Disney, conversely, monetizes its intangible assets across a deeply diversified wide moat ecosystem.
Right. If a Disney movie flops at the box office, it's a rounding error. They're still pulling in billions from theme parks, which act as a physical monopoly. I mean, you can't just build another Disney World next door.
No, you definitely can.
They have cruise lines, merchandising, and the massive cash cow of the ESPN cable bundle. Their moat is breadth and pricing power.
Now let's look at a scenario where the moat is completely derived from ecosystem lock-in. The aliens pit Hewlett-Packard against Apple.
Oh, this is a good one.
In 2005, both are primarily hardware companies. HP had a solid 12.2% ROE, and Apple was just slightly ahead at 13.7%. But the divergence over the next decade is staggering.
Let me guess. Apple takes off.
Apple's ROE explodes to almost 31%, and the stock jumps 975%. HP's ROE decays to 10%, and its stock basically flatlines.
This perfectly illustrates the power of high switching costs combined with intangible brand value.
Yeah.
HP was trapped in a race to the bottom. They were manufacturing run-of-the-mill, commoditized Windows PCs.
Right. If Dell or Lenovo offered a laptop for $50 less, the consumer jumped ship immediately because there was no friction. There's no loyalty to the HP hardware itself.
But Apple spent that decade meticulously constructing a walled garden. They didn't just sell you a phone, they sold you the iPhone, creating an unparalleled brand premium.
And more importantly, they lock you into iOS, the App Store, and iCloud.
Exactly. Once a user has their entire photo library, their purchased media, and their iMessage network trapped inside the Apple ecosystem, the psychological and technical friction of migrating to an Android device becomes prohibitively high. Apple's hardware margins were protected by their software mode.
So we've seen companies destroyed by changing trends and commoditization, but the next matchup reveals how the fundamental structure of an industry can act as a massive capital incinerator.
The aliens give us Southwest Airlines versus McDonald's. And this brings up one of my absolute favorite investing heuristics. It is far better to bet on a good horse than a good jockey.
It's a brilliant way to frame it. The horse is the underlying economic reality of the industry, and the jockey is the management team. Southwest Airlines had arguably the best jockeys in the business.
They were brilliantly managed, pioneered the low-cost carrier model, and had an incredible corporate culture.
But the airline industry is a fundamentally terrible horse.
It is a structural nightmare. For beginners, airlines are extraordinarily capital-intensive, which basically means a business requires a massive amount of physical money and equipment just to operate. You have to purchase depreciating planes that cost hundreds of millions of dollars.
You are at the absolute mercy of wildly fluctuating global jet fuel prices.
You have to negotiate with heavily unionized labor forces. And on top of all that, the consumer views a seat on a plane as a pure commodity. They just log on to an aggregator and buy the cheapest ticket available.
Exactly. During that 2005 to 2014 decade, despite a booming overall economy, major legacy carriers like Delta, Northwest, and American Airlines all filed for bankruptcy.
Wow.
Southwest survived because of its great jockeys, but its returns on equity still got slashed in half.
Wow.
You simply cannot outmanage a structurally flawed industry. McDonald's, however, is a magnificent horse.
Because McDonald's isn't really just selling burgers. They're operating a hyper-scalable real estate and franchising model. They use their massive global scale to maintain a relentless low-cost advantage in their supply chain.
They didn't have to battle fluctuating fuel costs or capital depreciation in the same way.
Right, they just collected franchise fees and rent while selling a globally recognized intangible asset. Consequently, their stock grew by 178%.
Which brings us to the final and perhaps most revealing test of the alien invasion. It highlights what happens when a moat is so deep, it actually protects a company from its own incompetence.
The matchup is Microsoft versus Verizon.
Now, let's be entirely objective about Microsoft's performance between 2005 and 2014 under Steve Ballmer. They made some historically catastrophic, unforced errors.
It was a decade of blunders. They completely missed the smartphone revolution. They incinerated billions of dollars acquiring Nokia, which was a total failure.
They poured endless capital into the Bing search engine to try and compete with Google and barely made a dent.
Right. By all traditional metrics of innovation, Microsoft was stumbling badly. Meanwhile, you have Verizon executing perfectly, building out this incredibly vital, reliable cellular infrastructure across the country. Yet, who wins the decade? Microsoft. Their stock rises 78%, and their ROE climbs to a staggering 35.1%.
How does a company actively mismanage its capital on new ventures and still compound wealth at that rate? It is the ultimate testament to the unbreakable power of the network effect and enterprise switching costs.
Microsoft's core Moat Windows and Microsoft Office was so heavily fortified that management's external failures simply couldn't breach the castle.
The entire global corporate infrastructure runs on Excel, Word, and Windows.
The switching costs we talked about earlier?
Exactly. Imagine going to the board of a multinational bank in 2010 and suggesting they move off Windows and rewrite all their legacy Excel macros to run on a new operating system.
They'd laugh you out of the room. The operational risk and retraining costs would be in the billions.
The global business world was fundamentally locked in. Microsoft was essentially collecting a toll on global white-collar productivity, and that toll booth funded all their failed experiments without damaging the core returns.
Verizon, on the other hand, is a solid business, but it suffers from the same capital intensity disease as the airlines.
Right.
To maintain their network, they literally have to dig trenches across the continent, to lay fiber optic cables, and spend billions securing spectrum rights and building cell towers. That constant crushing need for heavy capital expenditure puts a mathematical ceiling on how high their returns can go,
making it nearly impossible to sustain the truly elite profit margins that a software company can.
Okay, so to recap everything we've just covered for you. First, we looked at the candy shop versus the pet store, which taught us that sky-high returns are dangerous because they act as a magnet for aggressive competition.
Right.
Second, we defined the 4 true economic moats: intangible assets like Coke's brand, high switching costs like Oracle software, the network effect like Google's search engine, and low-cost advantages like Walmart's supply chain.
Spot on.
And finally, we used the 2005 alien invasion test to prove that without these moats, even the hottest trends or the best management teams will eventually get crushed by the market.
Warren Buffett summarized the mechanics of this perfectly when he observed, "Time is the friend of the wonderful company, the enemy of the mediocre."
Yeah, it's a great quote.
If a business lacks a moat, Time simply provides a wider window for competitors to bleed it dry. But if a company is structurally fortified, time becomes the engine that allows it to compound its wealth exponentially.
It all comes down to the architecture of survival. Well, that wraps up today's deep dive. Thank you so much for tuning in. Please don't forget to like this video, subscribe to our channel, share this discussion with anyone who might find it helpful, and support us so we can keep creating more educational finance content for you.
We really appreciate the support. But before you go, there is one final critical variable that I want you, the listener, to mull over on your own time.
Oh, right. The variable that keeps every CEO awake at night.
Yeah. We've just spent all this time establishing how incredibly powerful these traditional moats are: brands, enterprise scale, network lock-in. They are designed to defend against competitors trying to cross the water.
But we are currently living through an unprecedented acceleration in technological capabilities. The landscape is shifting exponentially faster today than it did back in 2005.
Exactly. So the provocative question you have to ask yourself now is this. In an age of rapid artificial intelligence, open source models, and massive digital disruption, what happens to a legacy business when a new technology doesn't just figure out a better way to cross their economic moat, but possesses the capability to evaporate the water entirely?